Everybody, welcome to the morning market briefing. It's Thursday, August 4th, 2022. Hope you are doing well out there. Market's basically flat right now. Dow futures up 3 basis points, S&P up 8, NASDAQ up 15. We do have oil up once again. We are waiting on some economic data in the form of jobless claims, but we do have ISM to discuss that came through. Services came in a little bit hot, 56.7 up from 55.3. New orders were strong. Employment was actually up. Prices down. We saw that on both sides of the ISM data this week, which is relative positivity. Ben, what are your major takeaways?
Yeah, I thought it was a much better than expected report than I expected. It was interesting because sometimes we've had better, worse numbers than this, but the commentary has been better. This time we had good numbers, but the commentary was a little bit soft, saying restaurant sales have softened over the past few weeks. Another consultant saying you can feel the economy weakening. Clients are making appropriate moves in anticipation of a recession. In professional, scientific, and technical services, they're saying hiring demand remains robust in most industry sectors. Tech has had a slowdown in hiring and layoffs. And then on the retail side, they're saying they're trying to attempt to match inventory levels to current lower sales trends. So the commentary is not so good, but the numbers were pretty good. And I especially am taking it as a positive that pricing has come off of its very lofty levels.
Good stuff. Yeah, it's kind of this weird, feels a little bit like in a transition period where we're getting commentary that maybe belies the data or vice versa.
It's like there's a storm coming and people are battening down the hatches and it's like, okay, here it comes. Have you ever seen the movie Day After Tomorrow? Yeah. It's almost like when they're in that eye of the storm and they say, okay, we got an hour and a half. And they had to go to get the medicine and it's beautiful blue sky out. And then the walls start coming in and everyone starts freezing.
Yeah. So interesting commentary, but data pretty good. Bank of England raising 50 bips. Tom, give us reaction on the monetary side, and then Ben, will throw it to you as our resident UK expert.
So pretty interesting information coming out of Bank of England. So they raised 50 bips today. If you recall, they were the first mover in terms of raising rates globally. And in fact, they were the first one to do a head fake too, because they were going to raise rates. I think it was in December and they chose not to. And that sent rates kind of spiraling a little bit. But they've been consecutively raising. They just did 50 basis points. They've been in relatively smaller moves. But the interesting read through that they gave is their thoughts on what inflation is going to look like going forward. At least for the UK. So for context, right now they're at 9.4% versus the US at 9.1. And they said, quote, inflationary pressures have intensified significantly. The latest rise in gas prices has led to another significant deterioration in the outlook for activity in the United Kingdom. So they're thinking that based on their modeling, they expect inflation in the UK to peak out at 13.3% in October. Because of the natural gas prices, because, obviously they can't get it from Russia. We're doing a lot of shipping from here to there. And the price obviously is going to continue to be elevated in going into the winter. So 13.3%, I mean, that's pretty ridiculous. And I think that from their point of view, they're only doing 50 basis points because, raising rates is not going to change the natural gas problem for them. That's going to continue to go through. They expect that they're still going to be at 9.5% inflation by the third quarter of 2023. And then they expect that to rapidly fall off. But that's a full year and change from now that they're still expecting to be almost 10% inflation. So it's definitely something to keep an eye on. They're going to have a really tough time moving forward unless, something really changes in terms of how they receive their energy. But luckily, the natural gas is not an issue we have here. Knock on wood, at least not at the moment. Something to keep an eye on. So one in the agenda here, Ben has it as key calamitous quotes, which is alliteration with 3 different letters, if you can believe it. GDP growth in the United Kingdom is slowing. The latest rise in gas prices has led to significant deterioration in the outlook for activity in the United Kingdom and for the rest of Europe. The United Kingdom is now projected to enter recession from the fourth quarter of this year. Real household post-tax income is projected to fall sharply in 2022 and 2003, while consumption growth turns negative. So, not a great outlook. I mean, it's pretty bleak. Obviously they benefited a lot from not being attached to Europe in terms of, being able to run their own monetary policy and not be tethered to, some of the worst countries in Europe. But at the same time, it's a pretty small nation. They don't have nearly the bargaining power that the ECB does, and so they've got to adjust accordingly. So, they're going to be in perhaps a more steep recession than maybe Germany will go into, but at least they don't have to worry about things just absolutely spiraling as a result of Portugal or Italy or Spain.
Yeah, it's interesting. I mean, we've talked a lot on this call and just in commentary. The struggles in Europe are robust. I mean, it's kind of if you think it's bad here, look over there. Been surprised by any of this? I mean,
I'm very surprised by it. I mean, this is the first case of a central bank actually admitting reality. And I don't even know if it's worse than Europe. I actually think Europe's going to be even worse than this, but they can't admit it. And England, they are just suckers for a rainy day. They love it. After 2008, rather than do stimulus, they said, we're going to have this age of austerity where we're going to cut deficits and we're going to really tighten our belts, eat potatoes for 3 years, go cold. I mean, the coal miners strike throughout their history, they just punish themselves. And I think that's exactly what the Bank of England is doing here. And that's to call for a recession that you're tightening rates into, that's beginning in the fourth quarter of this year and lasting through the entirety of 2023. When you're the central bank, to be calling for that and saying, yeah, we're going to be hiking rates into that. I mean, that's remarkable. No other central bank in the world would do that. And so I don't know.
I'm startled by their earnestness.
I mean, it needs to be done. I mean, that's the thing. And they're an island nation too. I mean, inflation is going to hit them harder because if you can't grow it or mine it on the island, you got to import it. And if you've got to, deal with the dumb ECB, or you've got to wait for it to come from us, I mean, you're kind of in a no-win scenario. So, I mean, they're going to take it on the chin, but the difference is, they've got autonomy and they've got that backbone that a lot of countries don't have.
And I think what's going to happen is that you're going to end up seeing the British people really pull back on spending, which I think some people would say, well, that creates a self-fulfilling prophecy then. But I actually think that it helps to mitigate any credit risk that you ultimately have, defaults that could really take down the system, which you could be at risk with, especially on mainland Europe.
And I think they kind of like playing that role to an extent. I mean, we were talking about that before the call. Like, no one likes to be downtrodden more than the Brits.
Yep.
So, not to stereotype, but
yeah, they love it. I mean, they live in the rain all day.
Yeah,
and they like it.
I mean, there's other options. Moving to earnings, booking, seeing a slowdown. Specifically, some of their commentary I thought on the airline space was kind of interesting. Ben, what are you seeing? What travel trends are showing up?
Yeah, so they see a bit of a decline. So they expect to be about up 4% for room nights in the third quarter, but they were up 16% in Q2. So definitely seeing a bit of a deceleration there. And they say they were asked why they expect this deceleration, and they said, and we hear about people saying how hard it's been in some airports. We read about some of the troubles with cancellations and the crowds. They have to come 5 hours early at the airport and all these things. So why the deceleration? It's hard to say. And we can all hypothesize about what that is and why and all that. But I do believe there's tremendous opportunity still in this recovery. So it was kind of interesting because I thought they were going to talk about the weakening macro environment. But if anything, they were saying the macro environment is pretty strong and the recovery is continuing. And it's just that people don't want to travel because they don't want to deal with the crowds. And I don't know if that's the case. I think that people aren't traveling as much and booking hotels because they're worried about money. But maybe I'm just naive. But I don't know. I don't hear a lot of people saying there's no way I'm going to travel because of the crowds.
Yeah, I haven't heard that in a while.
Yeah.
I mean, it's just
maybe if you live in Massachusetts or California, where that's more of a thing. I think maybe that might be regional. The South has been open and is fairly open, but I think there's still a lot of like mask wearing and fear in some of those more places that were locked down had a lot more of that pushed on them, I think.
Yeah, I mean, that may be it, but yeah, I mean, I certainly would not say that at a broad national or even global level that the crowd is limiting travel.
Yeah.
Yeah.
I don't know.
I mean, in context of everything else that we're seeing,
Yeah.
I would say the macro seems the obvious reason.
Yeah. Maybe people aren't traveling because tickets are unbelievably expensive and they have concerns about their jobs.
Yeah. Yeah.
I don't know. Maybe sometimes it's just right in front of you. QRVO, not to be confused with QRVO, reported earnings. Guidance for 23 was relatively good, but they did talk about reducing factory utilization. Ben, what's that mean when people talk about that? What are they actually saying?
So basically, QRVO is saying that the Android market is just fallen off significantly, and they're reducing factory utilization to make sure that inventory doesn't build up. The problem is with a high fixed cost business like QRVO, making semiconductors, you're going to have that cost spread out over fewer goods, which means that you're going to be making less profit margin on every product that you sell because the allocated cost is higher. As a result, I think that QRVO is going to be pressured significantly on the gross margin line over the next 2 quarters. It was up like 7% last night. It might be down now, which I think would be an appropriate response.
Yeah, it's down right now, about 3%. Clorox, meanwhile, talk about bad guidance. Gave guidance in the range of 385 to 422 for fiscal year 23. The expectation was for 526. Woof. I don't know. I mean, they're down about 5%. I don't know if that's enough.
I mean, this is a company that made $7.25 last year, and they're going to make half that in the coming year. I mean, that's pretty remarkable for a company that should be a consumer staple stock. Now, of course, people spending a little bit less on household cleaners, but nevertheless, this is a pretty bad report. A lot of it's due to the cost side, and they are increasing prices dramatically. So this is why when people talk about inflation peaking, I don't get it, because if you look at what happened, their pricing was up, about 3 to 4% last quarter. This quarter was up 10%. And they took another round of pricing in July, and that was the largest price increase of the 3 that had been taken over the last 12 months. Looking into the next year, you'll see favorable prices in the high single digit range and volume down low single digits. So again, we're going to be expecting 8 to 10% price increases, which again is higher than what we saw last year for Clorox. We're going to be expecting accelerating pricing for Clorox for these household products over the next 12 months. So when people are talking about inflation peaking, I just don't buy it, because it's not fitting with a lot what these companies are saying. And they're saying that they still have pricing power because elasticities are lower than normal. So if anything, they're emboldened to raise prices even faster because, I mean, they need it. I mean, their earnings are still going to be down
They
half.
have to.
Yeah.
Ben, what do we hear from Costco? Stock's about flat. Interestingly, did just get upgraded about 45 minutes ago from JP Morgan. Price target raised to 589 from 531. It's at about 545, flat right now. What do we hear on their trends?
I think it was definitely a bit soft at the margin. It was a tough comparison period, and inflation, they said, was consistent with June. So again, not seeing a deceleration in pricing. They said they were strongest in the Midwest and the Southeast. And the strongest merchandise category continues to be just foods and sundry items like paper towels and toilet paper and that sort of thing, as well as gasoline. But what I am concerned about with Costco is they announce their monthly sales, but then they also have these quarterly reports. And I would be concerned about margin degradation in the quarterly report, because while food and sundries and ancillary items performed well, those are low margin areas. Fresh foods and other goods like your TVs, etc., furniture, those all decelerated again. If you look at the other goods, you were up low double digits in May, up high single digits in June, and up low to mid single digits in July. So you're seeing this overall tapering of demand for those other goods, clothing and your hardline goods, which I think makes it tough for Costco at the margin. Having said that, Costco does have some levers. I expect them to raise membership fees in the coming, 6 to 12 months. And I think that might be good for the stock. So we still own Costco. We like Costco, but they're not immune to a lot of these pressures that we're seeing in retail.
Yeah, I think they may be somewhat insulated just by virtue of their business, but certainly not immune. And I think how that plays out in a retailer is just the fact that we're comfortable holding Costco, whereas look at how many big name retailers, even big name retailers that we've discussed on this call that we frankly just don't want to touch. And so I think that's kind of how it plays out on an actionable level.
Bed Bath and Beyond, just one coda to this call. Bed Bath and Beyond can't even raise debt in public markets right now. They're going to private markets, trying to get private loans to keep the doors open. Again, we've talked about Bed Bath and Beyond before. I would not be surprised if you see some sort of restructuring using bankruptcy law by the end of the year.
Yeah, I agree. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day. Talk to you soon.